right, well, g'day there, everybody. Thanks a lot for joining me on this Wednesday afternoon market recap. A lot to go through. A lot has happened over the past three sessions on the S&P, the Dow, the Nasdaq, and also the broader markets as well, especially when referencing that of market breadth, which is very important, especially during, or at least during times when we're trying to differentiate between that of the beginning of, or at least the continuation of, right, a bull market advance, and that of a very early on transition into that of a bear market. I think that is starting to become a little bit more clearer for the majority at this particular point. Yes, it started to look like, very much so, a V. You can see the vortex, or at least the bottom of that V, the curvature or lack thereof. You can see the initial acceleration out of the bottom, March 23rd. But really since this point, and really since just before mid-April, it's really started to decelerate. In fact, it's really starting to look, or at least begin to exhaust itself. Take a look at the S&P 500 at this particular point as at the close on Wednesday. Today we closed down, I think 1.75%. This is in addition to the losses that were made yesterday, right? And what's most important about this is that, I mean, these prices that we're starting to drill on back into are prices whereby, I mean, we saw very early on in the period of April. This is in fact the 9th of April, this particular candlestick, whereby you can see these wicks, which are starting to cross, right? They're starting to overlap, which again is suggesting that a lot of the price action which has happened over the past month or so, it's really been that initial clinch of speculative yield. Again, the FOMO effect that people are having, jumping back into equity prices, expecting a cannonball shot back on up to retest the most recent all-time highs in the period of February. As I have said in the past, that narrative which was driving the market, unfortunately, through to the peak prior to COVID, or at least the reaction of the market of the COVID outbreak globally speaking. And again, the continuation since declaring it that of a pandemic. Unfortunately, the world that was before this, or at least before this event, it's not going to be restored. And again, a lot of people, unfortunately, are cannonballing back into the market, assuming that this is going to be the case. Unfortunately, it is not. Times have changed, and the market itself is starting to, or at least it appears to be, again, number one, holding, or at least being suppressed by overhead resistance. But again, the curvature, or at least that initial compression and the slingshot out of these distressed asset price levels, back on the 23rd of March, are really starting to decelerate. And you can see it already in the momentum indicators, not only when you sort of overlay it with the S&P 500, but more importantly, I believe, with the Russell 2000. Very interesting times. Again, we've got a series of dark candlesticks. We've got that outside day engulfing candle as at Tuesday. Today, we saw follow through all the way really for the majority of Wednesday's session. We did see a little bit of relief, sort of bid enter the market towards the end of the session. But again, this is largely, and we spoke about this over the weekend in that pro analysis class, in relation to Jerome Powell's comments today, that pretty much he poured cold water on the concept of negative interest rates for the time being. Yes, he did leave the door open. He didn't rule it out completely, but a lot of what the market has been doing more recently, especially with the implied Fed funds rate, is that they've been pricing in negative interest rates to the extent, I believe, of pretty much negative 40 basis points, which was huge. And if you have a look at the banking sort of sectors of different countries in different regions around the world that have implemented and introduced negative interest rate policy, it is a complete disaster, not only for the banking sector, but also for the equity markets as a whole. If you're a bear out there, really, and if you're wanting the market to go lower, again, that is not myself. I'm just working with, I guess, the objective reality of what's staring at us in the face. But if you have a look at what Japan has done in the banking sector index, right, it's one thing to have little Japan do it. It's a little bit more consequential, you could say, for the European Union to implement negative interest rate policy. Again, back in 2011, you can see the consequences of that for their banking stocks and the broader economy and the equity markets as a whole. But when you start sort of referencing it in regard to the US, right, which is not only domestically speaking, but it is the caretaker and really the center point for global finance. I mean, if you really wanted to bank on, right, equity prices losing value, it would be through negative interest rate policy. So again, he's coming out and he said, no, it's a policy that they're not looking for, or at least looking to implement at this particular point. We'll pay attention on the implied Fed funds rate at this particular point, or at least moving forward, at least later into 2020, and probably more so, which would be more important into 2021. But equity prices are already reacting on this, because really interest rates, when you think about it, they're already as low as what they can generally go. Yes, without, of course, withstanding negative interest rate policy. So everything is essentially priced in at this particular point. You've got a market which is overextended, it's overbought, it's overvalued. The PE ratios, or at least the forward 12-month looking PE ratios, are still getting smashed. They're getting smashed below the March 23rd lows. There's a big disconnect at this particular point between the bond market and equity prices, which is, again, over the weekend, we're talking about these jaws and the divergence, which is setting up with equity prices coming back and up to retest these overhead resistance areas. As such, and if you think about it like this, the S&P 500, on at least 3 occasions, if you factor in this particular candlestick, and of course more recently the past number of candlesticks, it's come back and up into, say, that 50% retracement of the first initial wave down. But even 4 times if you go back to the candlestick on the 14th of April as well. So very clearly we're finding rejection. As I have said in the past, generally historically what happens is that the S&P 500, being sort of the center point of all the markets, it generally does come back on up and retest both the 100 and the 200 during these transitional phases. That hasn't happened yet. As you can see on the right-hand corner of my screen, we are now below 3,000, or at least the print on these simple weighted moving averages. They were just above 3,000, but again, as time continues, they're going to drag lower as price, or as long as price remains below them. We've got very close on a number of occasions. 2,950 pretty much is the high at this particular point, but it does leave the doorway open for equities to just have one last gasp back on up to 3,000, maybe overshoot it, albeit temporarily for a couple of sessions at most, before it definitively prints, of course, that macro lower high. Now, again, you have to keep this in context because a lot of people, unfortunately, again, are cannonballing into the equity markets. I think if you just have a look at some of the sentiment indications, and also when you think about new brokerage accounts being opened as well, there's a lot of unfortunate retail money, otherwise known as sort of silly money, jumping into the market, thinking that they're getting this market at a discount after the most recent sell-off. Again, the GDP forecasts are continuing to completely implode at this particular point, which is, again, just making these valuations even more obscene. And in fact, what's interesting as well is that the market itself is more overvalued here than what it was back in the period of February, based on those expectations of future GDP prints, especially in Q2. We are going to see a rebound to some extent in 3 and 4. But if this is a transitional bear market, you would expect, unfortunately, to see the economy roll back over towards the end of 2020. And that's probably what the market is pricing in at this particular point. Everyone knows that Q2 is going to be an absolute horror show. And I think the actual V itself, which a lot of people are speculating on, or at least thinking which is sort of going to arrive and propel asset prices higher, I believe it's already pricing in, of course, the underweight forecast, which we are going to see, and what people are expect to be a pretty decent rebound in 3 and 4. I simply don't think it's happening. And this is the reality starting to catch on up into equity prices as you see it continuing to roll over below, the 100 and the 200-day simple moving averages. Again, think about the V. It's sort of disconnected from the midpoint in April. We got pretty much 1 month of alleviation, so to speak, of a pretty much a slingshot move out of the March 23rd low. Since then, the Dow Jones Industrial Average, which was what we've been referencing for a number of weeks now and continuing to do so, it's largely just treading water and moving absolutely sideways. In fact, what we have done is now we're pricing in the neckline, and this is the big inflection point on the equity markets moving forward. You can see it as well on the S&P 500, whether or not it's coming in at, say, 2,780, or whether or not it's just below it and just above, say, 2,720. It's largely inconsequential and immaterial if you think about the longer-term effects of this on price over the next 1 to 2 years. You can see it building in the chart patterns. You can see it again continuing to show up in individual candlesticks whenever we do see down days. And a lot of these bullish candlesticks that we have seen have been in aftermarket hours, which have just simply presented spinning top candlesticks, gravestone dojis. You can say shooting stars as well. I mean, just not the most sort of nice, so to speak, of bullish candlesticks, even though the net momentum recently has been to the upside. Also think about the volume, which is just completely, continuing to trail out. The volume on these markets, notwithstanding, of course, a couple of individual stocks, it's just absolutely dreadful. There's no participation. Institutions are not getting involved on this bullish bounce, which is quite interesting as well. The smart money flows are flowing out of the market. And in fact, what we've been speaking about too has been the NASDAQ. Number one, that was meant to be a one, but number one, the concentration. When you think about a handful of stocks, I think it's 5. You've got Apple, Amazon, you have Google, you've got Microsoft in there. Then you can sort of sprinkle in either Facebook or Walmart as well. But the market cap of those select 5 shares is now larger or greater than 20% of the entire market cap of each of the markets that they are traded on, which is interesting because that last phenom, it hasn't happened since the peak of the dot-com bubble at the turn of the millennium as well. So if we start to see weakness in these tech companies, or at least a handful of these tech companies, you can already see the double tops being priced in. At this particular point, you've got a bunch of leaning double tops as well. And one thing we've referenced and pointed out is that during this transition too, and Amazon's a really great example of this, post earnings, it was down $187. Since then, and really on the back of that individual candlestick, we've been speaking about how it makes a lot of sense that given that the NASDAQ continues to climb higher, that we would see, again, the gap closure of this, but then pay attention to any reversal candlesticks that are setting up at somewhere between 2.4 and 2.475. Well, my daily, right, because I haven't got the final print at this particular point, but my daily close as at yesterday, this is being Tuesday, this candlestick here, you can see the very clear rejection. Amazon, again, was down today. So you can see the windows that are being closed more recently after earnings or even prior, or at least during the very initial sort of early sell-off, which goes all the way back to, if I can zoom on out and show you this, even for Apple as well. Back in the period of February, you can see the rejection, or at least the closure and the beginning of the rejection up and around these areas. Pay attention to volume. Volume is getting sucked out of these stocks. Pay attention to it. On these bounces at new all-time highs, you want to see participation in these stocks. It's simply not there. Microsoft, again, look at the direction of the volume. Look at Google as well. So this is the cream of the crop, that we're looking at this particular point. Have a look at the volume. It's going down. There's divergences all over the place. And if we start to see these tech companies crack, a lot of them have already priced in double tops. Have a look at Netflix as well. You can see the right double just here. You can see the neckline very clearly positioned as well. Look at the volume on this most recent bounce. These are the best companies that are holding up this market at this particular point. If they start to roll, and have a look at the Dow Jones, it's already starting to roll. In fact, if I show you this on the exponentials, we're below them, even though technically speaking, we have to throw the exponentials out the window because we are technically range bound. But we are certainly below the 3 key exponentially weighted moving averages. The same is true, albeit very marginally, on the S&P 500. But what's very critical, and I want you to really understand this, is that when we go on out, and I keep repeating myself in regard to this, but it's critical. Historically speaking, the 10 and the 20 monthly, when you see a cross, both bullish or bearish, it signifies the beginning of a trend. And a lot of people, again, naturally so, are being lulled into the sense of some form of a new bull market, which is just profound and just... it's rather bizarre at this particular point to assume that, given, of course, how far we've gone, how long in duration this bull market has lasted, not to mention, of course, the complete shutdown since essentially March, if not February, of economies around the world. You can't simply just flick a switch and expect things are going back to how they were again. That was describing the narrative prior to COVID. That narrative that characterized the market top, it's not coming back. And a lot of people are assuming that it is, or at least they're just jumping back on in there, reaching for that speculative yield right at the worst time, right as you can see, of course, that definitive neckline, or at least not the neckline, but that right shoulder being formed right on the monthly time frame of the S&P 500. And it's exactly at that worst location. In fact, we've temporarily pushed above the 10. We've pushed above, of course, the 20 as well. But we're back down below it. Yes, we haven't technically crossed yet, but this to me, and if we do see any follow through, because again, we are very extended and overbought on the daily time frame, if we see weakness, expect the 10 to cross the 20. And the last time, again, this actually confirmed in that direction was all the way back in 2008, prior to the lows being taken out and the market moving into, right, that definitive contraction. I think a very similar sort of scenario or situation is underway at the moment. And of course, the first time we got the bullish cross of the 10 above the 20 was the beginning of the bull market. So again, we've got one signal here, and since then it's remained bullish up until this current juncture, whereby we are very close, and if we see weakness, to actually seeing that signal set up again. In fact, if I show you this on the Dow Jones Industrial Average, pay attention, we've already done that. We've already achieved that. We got very close in 15 and 16 to actually crossing bearish. That was when, again, the markets were going through that sort of protracted, sideways market move where we were very close to moving into a technical recession. But again, even factoring that and not seeing these crosses since, of course, that period in 2008, these signals mean something. And if you're not paying attention to them, or at least you're not respecting, of course, the historical significance of these crosses, well, then unfortunately, all right, for you, I think there's going to be a little bit of pain over the next coming months. All you need to do is just flip, of course, your horizon. Don't like to obviously speak in market tones being that of bearish. In fact, for the entirety of 2019, we were bullish. And we've been bullish for a very long time on these markets, but now is not the time to be complacent. That's really what I'm trying to say. Also, when you think about it too, well, I've just lost my charts. This is not good news. Have a look at this. NavSuite has stopped marking. Let's close the program. My apologies for this. I run obviously Windows in the background It's called Parallels, obviously, if anyone uses Mac, which I think a lot of people do. I'm reloading it. Sometimes it crashes. My apologies for this, but just bear with me a moment because I want to show you this relationship. You think about people talking about the beginning of a new bull market narrative being priced into equities. If you see that, you should see at least financial participation, or at least the financials, supporting that narrative or supporting that viewpoint. Okay, there we go. Just bear with me a second. If I start bringing up some of these financials, I'm just going to bring up one in particular and also just apply it to the financial component of another. But if you have a look at Wells Fargo at this particular point, you can see, of course, the March 23rd lows. We've seen this little spike rally. It's turned down. We've tried to rally again. We've produced a subsequent lower high. What's most important about this is that we've already taken out the March 23rd lows. This is not factoring in, of course, the price action as at, right, the close on Wednesday. So you can see again, the financials to some extent leading this market lower, or at least that divergence when you think about it outside of tech, it's not looking all that good. Have a look at General Electric, which again has a financial component to it. Not that stock just there, but this one, hopefully I'm bringing up right now. Very similar pattern. We have taken out the lows back in March 23rd as well. This is a stock that was priced up at $13. In February, it's now down at $6. It's actually below that as at the close on Friday as well. So, I mean, if you want to go out and take longer term approaches of views to this market, just to put this in context of where we are, it's really not looking good. It's really not looking good. And you can be frightened by it. You can do nothing by it. You can have a rosy, optimistic outlook and try and support that view somehow. But at the same time, if you sort of want to get on board with reality a little bit, at least through what I'm looking at here, it's not really all that difficult to do so. It's just simply disconnecting the emotional side or the aspect of trading and disconnecting the assumption that equity prices always go up, because they go through periods, they go through cycles. And it looks as though this cycle is becoming clearer and clearer and clearer, unfortunately, right, to the majority of people who are slowly coming to the standpoint that this Fed-induced sort of bounce that we've seen is really beginning to exhaust. All right, so it's very critical that you understand that. Again, I think that we are going to linger up here for an indefinite period of time. Remember, generally get that first retest of the 100 and the 200 simple moving averages as well. We haven't done that yet. You can see we're closing at 2820. This is coming up again just shy of 3,000. It's 2,999. We'll see whether or not the S&P 500 has the steam to actually get back on up into that area. But as I say that, have a look at these oscillators. They're all turning down. The MACD's just crossed. The RSI's moving down as well. The one market, obviously, that's holding up a lot better than every other market is obviously tech. Again, think about the concentration of that select handful of stocks. A lot of them are very close to their highs back in February. They've closed windows. They're starting to turn. There's no volume in them. You've got double tops all over the place. And what that means, obviously, for the NASDAQ as well, which is going to be very critical. I feel as though I've missed something out. I mean, I can reference market breadth. This is very critical. Again, when you go through transitions in equity prices and directions in equity prices, or at least the market indices, very early on, you want to, at least during that transition, you want to pay attention to market breadth. The McClellan oscillator is suggesting, I don't have it on my template at the moment, but there's just no participation in this rally. Again, you can really see it through volume in and of itself. But if you think about the smaller caps, the 2,000 smaller caps, or the market cap of those individual companies, a lot bigger market too, having 2,000 companies in it. You can see it already rolling over. In fact, if you go back to the peak over here of what has been that compression relief rally since, or out of the March 23rd lows, this actually ended on the 29th of April. Since then, we've had one more attempt to close it. And again, you can see these bearish gaps that are filled. We try and push back on up above it. We're finding rejection. And you can see the neckline again. If you wanted to call this a leaning double top, I mean, it's much of a muchness. You're really sort of clinching at straws at that particular point. But it really seems as though we're starting to diverge away from that V narrative on a number of these markets. The only market or indice that is holding up still is the NASDAQ. But I don't have rosy glasses, or at least my perspective on this market is that this is going to have to succumb to gravity, all right? The gravity of valuations and price to earnings ratios, and of course the contraction in GDP that we're seeing, the estimates, the forward-looking estimates too. So I think there's a lot of silly people, unfortunately, or sort of just people who are unfamiliar with the concept of market timing and also market transitions, that again, still assume somehow that even if you go back retrospectively and think about this, generally bear market cycles, they last for anywhere, generally 24 months, right? I mean, you go back and think about the 07 peak into the depths of 09, pretty much 2 years. You go back into the same period. If I can go back to 2000, this is the NASDAQ. I mean, it lasted a little bit longer, but again, roughly 2 years, to suggest that with, of course, what has happened on the humanitarian aspect, which is absolutely, nothing short of a tragedy at this particular point, but to think that the consequences of this, given that really largely the lockdowns are still in effect around the world, I think it was California or some county anyway, who just pretty much came out and said that they're looking at extending it through to July. Now it's sort of backpedaled as it sort of today or yesterday, I think it was, even into August. But to suggest and to think that this has run its course in the space of 1.5 months, I think it's just silly. It's a little bit, it's lunacy at this particular point, because when you're talking about these big market change in directions, once that direction, or at least once the boat, right, that big passenger liner, so to speak, is turned around, and it takes time for it to slow and then to eventually turn. Once it starts moving in that opposite direction, it generally stays in that direction for a prolonged period of time. And this is the boat trying to get back on up, or at least to move back into, to restore that previous narrative. And that narrative, to use the same analogy, that ship has sailed. It's not coming back. You have to have rocks in your head to assume that the world itself is moving back into a state that it was, which was propelling and characterizing what is the peak in equity prices through to the close, right, during that February high. I mean, there's no chance that that is happening, unfortunately. And that's just speaking, again, objective truths at this particular point, which I'll always do. But anyway, that'll probably do us as this Wednesday afternoon market recap. Please don't do anything silly out there in the equity markets. I think you can tell through listening to me that if you're considering buying equities at this time, thinking the Fed has your back, I think that's dangerous. I think there's a big disconnect between the economy and what equity prices are doing. But I think that disconnect, it's going to converge once again. And unfortunately, what that means, if you're looking at the 12-month future, right, estimates of earnings, those estimates are far below that of the March lows at this particular time. Yes, they are going to see a rebound, but the bond market is suggesting that equity prices have disconnected from reality. And that's exactly what we're seeing, and we're continuing to see build, right, at this upper resistance area, coming at the 0.618 fib, and also these longer-term simple moving averages as well. Pay attention to that. Pay attention to those monthly 10 and 20 exponentially weighted averages too. Historically, they are very accurate. They don't give false signals. If you see that cross occur on the S&P 500, just strap on in. It's going to get ugly. And the last market which is going to crack, if it does, is going to be the NASDAQ. But we're already starting to see, in my opinion, complete exhaustion. With the amount of candlesticks that we're seeing, that we're suggesting the reversals, this is going to take a little bit of time. But there's a good chance that we have now priced in, right, some form of a peak of this equity rally that we've seen off from the March 23rd lows. So now is not the time, in my opinion, to be stepping up and taking risk or putting risk on in terms of bullish trades, right, buying stocks. You're best off, in my opinion, and I can't give you any specific advice, but really if you wanted to do that, I'd just suggest stay in cash if you're not prepared to take the bearish side of the trade at this particular point. Stay in cash, preserve your capital, and allow this market to shake out the noise to continue for as long as it wants around here. But again, the technical picture here is very clear, and it's very obvious as well, right? That narrative of equity prices cannonballing, creating the V, seeing some form of an economic recovery in the space of 1 to 2 months, it doesn't look to be the case. And this is really starting to move horizontally, and who knows what it's going to take, if anything, right? It's sort of like a W, right? At the moment, it's coming back down to the bottom, or it's going to be some form of, well, that was not meant to be a 6. I mean, it could just look like a really prolonged Q, right? Direction of prices over here. But we'll see. Time will tell. But again, just trying to be very clear and objective in the charts. And I think that's really all that matters at this particular time. And it's really all that does matter in general if you're wanting to trade equities or any financial instrument that is charted. All right, so if you want to learn more, jump into that pro analysis class Saturday. The classes are up online. There's a huge backlog too of material going back to 2019 as well. Very rarely do I delete it, but sometimes I need to cull some of those videos because it just helps the page load a little bit more sort of faster, and it's a little bit more cleaner. There's less of a lag. It just helps the user experience when they're clicking on the weekend videos. But I would again encourage you to jump into that pro analysis class as well. I think it was actually the 2nd of May where I put out that important YouTube video as well, referencing what was going on in the markets. Again, a little bit of a timestamp. You can go back and have a look at that. Otherwise, everyone, stay safe. Look after yourself. Look after your loved ones, your neighbors too. And we'll just keep tracking with these equity markets moving forward. All the best. It's James signing off on behalf of Pivot Point Trading. Farewell.